Hello, and welcome to Linking Climate Risk to Finance Reports. This is a guide for sustainability professionals undertaking climate-related financial disclosure. My name is Kim Dare. I'm a sustainability and climate governance professional, and in this presentation I'm going to take you through the context for leadership, the basics of financial reports, and bringing in the climate change risks. Climate-related financial disclosure came from the financial sector. It came from people who have money, who don't want to lose that money because companies haven't either managed the physical impacts of climate change or the transition risks associated with the transition to a net zero economy. In many countries, companies already have responsibility to go and manage both risks and finances. And certainly that is the case in Australia under the Corporations Act. And under the Corporations Act, the directors and the officers. So the officers is anybody that the board of directors reasonably relies on for advice and informs the board decision making. So both directors and officers have a responsibility to consider financial risks and opportunities, to keep the business solvent, and to manage any material risks to the organisation. That includes risks from weather-related events, and we know that climate is just weather repeated over time. And it also means the transition to a net zero economy, because we know there's increasing pressure to get to net zero, and this pressure is coming from investors, legislators, customers. So these are risks that are here that already need to be managed. They're known risks. After further information about directors' duties as they relate to climate change, then two really good resources that I recommend for the Australian audience are either the Huntley opinions, and there is, at the time of recording, 3 different opinions covering the changing legal landscape and different elements of sustainability and climate responsibilities. There's also the Climate Governance Initiative, and that is an international project which in Australia is managed by the Australian Institute of Company Directors. With that, let's get into the general purpose finance reports. So the general purpose finance reports are set out under the Australian Accounting Standards, which is based on the International Accounting Standards. And this is basically a standardized methodology to ensure that anybody who has an interest in the financial performance of the company has the relevant information they need to make a decision about whether or not they want to engage in the organisation. So board and management need to know about the organisation's finances, but so do investors, shareholders, banks. The other category of people who might need to know about our finances are customers and suppliers. Suppliers don't want to end up in a situation where you own or you physically have possession of their stock, but perhaps you haven't paid for it yet. And then if you go into receivership, they might end up in this big legal battle over who actually owns that stock and whether or not they can get that stock back. That's just a risk that suppliers don't want to have to go through. Similarly, although customers, they might have a short-term relationship with you, they might be buying a bucket of paint, they're in, they're out of your store. Or they might have a much longer-term relationship with you. Maybe they need you to construct something for you, whether it's a government infrastructure project, whether it's a business needing you to build a warehouse, a store. Whoever it is, they want to know that you are going to be financially viable for the length of the project. So if you think that it's possible that somebody has a financial interest in your organisation, they probably do, and it's important to consider that when we talk about climate-related financial disclosure. The first thing that we're going to talk about is the director's declaration and the going concern. So the directors need to make a formal statement that in their best opinion, the organisation is going to be financially viable for at least the next 12 months. And that's the going concern, that the organisation will be viable for at least 12 months. When the directors make a declaration that in their professional opinion the organisation is going to be viable for at least 12 months, then they're stating not only have they considered the organisation's current financial position, but they're stating that they've also considered the risks that the business is likely to be facing, the business opportunities, the organisation's business strategy, operational plan, risk management plan, and financial management plan. And that considering all of these things, yes, it is reasonable for them to assume that the business is going to still be around. Now, we know that climate change is a risk posed to businesses. So when we look at risks, opportunities, risk management, and financial management, the climate impacts and how this impacts the organisation need to have been considered in the going concern. The next element that we're going to look at is the balance sheet or the statement of financial position. Now, this is about the organisation's assets and liabilities, but it's accrued accounting, and it's important for us to understand what that means. So accrued accounting is understanding what we have, what we've spent, but also understanding what somebody reasonably owes us and what we reasonably owe somebody else. So to give an example, let's say that you've bought a house, your name is on the title, you own that house, the entire value of that house, but you've probably got a loan that you're paying off in order to acquire that house. So the value of that loan goes on the balance sheet as well. But you've got how much you owe over the current 12 months, so your current liabilities, and you've got how much that you need to pay off on the loan in the long term, so anything outside of this financial year. That's your non-current liabilities. You also have current assets and non-current assets. So your house, assuming that you're not planning on selling it in the next 12 months, is a non-current asset, whereas anything else, any stock, anything that you can sell within 3 months, that is considered to be a current asset. So when we're talking about assets, you've heard me mention stock, you've heard me mention buildings, any infrastructure that your organisation owns, any stock, any physical asset. If it's impacted by climate change, then this is where we go and look in our finance reports. Any of those risks you'll find here. You'll also find that any insurance that covers or protects assets against damage, if you're at risk of losing that, then this has an implication for your balance sheet and the risks to your balance sheet. When it comes to liabilities, something that we talk about that can either be a risk or an opportunity in the climate change space is the cost of financing our business and the cost of loans. So we know your loan is likely to be more expensive if you don't have a net zero strategy, and you're likely to get much cheaper finance if you do have a realistically net zero strategy. So there are risks and opportunities that we need to be able to talk about and disclose when it comes to our finances. The next statement is the profit and loss statement, also called the income statement. This is really showing changes that have happened over the last 12 months in terms of your finances. So it's really looking at things like all the stock that you've purchased, it's looking at all the maintenance that you've paid for, it's looking at all your staff wages, your sick leave, etc., etc. Anything that's operational, this is the conversation that it's having. So anytime you're talking about an operational risk, whether or not you're talking about, people being on sick leave due to heat stress, whether you're talking about needing to do more maintenance because of various weather events, it's all going to be reflected in your profit and loss statement. The cash flow statement is exactly what it sounds like. It is cash accounting, and it's understanding the cash that's coming in and out of your organisation. It's different to accrued accounting. When we look at cash flow accounting, we're looking at have and don't have. When we're looking at accrued accounting, yes, we're looking at have and don't have, but we're also looking at what I am reasonably owed and what I reasonably expect to owe. And so what this means is there can be a big variation or a small variation between your cash flow statement and, for example, your profit and loss statement. I want you to imagine the situation where you have small short-term loans to customers, whether that's lay-bys, whether that's buy now, pay later schemes. If your customers are increasingly under financial stress, then they're more likely to not be able to go and make those payments. They're more likely to go and ask for a longer payment period or to actually default on that. And that's a risk. And how much that risk increases is going to be reflected on the difference between your cash flow statement and your profit and loss statement. We also see it when it comes to suppliers paying you on time, when it comes to customers paying you on time. So when we have a big gap between our cash flow statement and our profit and loss statement, then we as an organisation need to have a serious conversation about our cash flow and about the risks to our organisation of being able to maintain and pay our business expenses. The final two things that I want to talk about are the statement and change in equity and the notes to the finance report. The statement and change in equity essentially tells us whether we're richer or poorer than when we were 12 months ago. I don't want you to worry too much about trying to link your climate change risks to this part of the report, because what happens in the other three financial statements is going to impact the change in equity, and so you'll have already captured your climate change risks elsewhere. I do, however, want to draw your attention to a couple of elements in the notes to the finance report, and this is where we have our really important assumptions and disclosures about how we've calculated different elements, in particular how we acknowledge uncertainty in our finance reports. The first thing I want to bring your attention to is the reserves, and the reserves will be a tiny little section at the end of your balance sheet, but you'll also have an explanation about it in your notes, and it will say how much of the reserves is money owed to shareholders, how much is set aside for a big new project, and how much is insurance reserves. Currently, outside of the finance sector, not many people have insurance reserves, but if your company is going to be at risk of losing its insurance, then it's perhaps timely that we as organisations start having conversations about whether or not we need to build insurance reserves. We also have fair value, and fair value is when we say, what's the value of my assets over this 12 months? Has, for example, the property market gone up and down? And how do I actually go and represent that? Now, you can imagine if you have an asset that's subject to sea level rise, and we're really looking at what's the value of my asset in this 12 months, there can be a bit of a disparity, and I don't have a clear answer for you about how we go and do that. But I will recommend that you keep an eye on the International Sustainability Standards Board to see what changes over the coming years about how do we disclose the fact that our assets not going to have value into perpetuity if it's land, or that it could suddenly lose its value at any point in time due to a storm surge. So this is something that I do expect to change over time, and something that sustainability professionals doing financial disclosure will need to keep an eye on. So in summary, any risk related to your assets or your stock is going to be part of your balance sheet. Any opportunities with getting cheaper finance because you have a net zero strategy is going to be again related to your balance sheet. Operational risks, including things like maintenance, are going to be related to your profit and loss statement. And any risks with, for example, customers delaying payments because they've got financial stress due to climate change, that's going to link to your cash flow statement. I hope this has been helpful for you, and good luck with your climate-related financial disclosure.